Lawrence White is a professor of economics at NYU Stern School of Business. He served as a board member of the Federal Home Loan Bank Board, and he is also the co-author of Guaranteed to Fail, Fannie Mae, Freddie Mac, and the debacle of mortgage finance. Also with us is Bloomberg News finance reporter James Sterngold. So obviously a lot to talk about with this latest TARP announcement. Larry, thank you so much for coming in to talk to us, and it's fortuitous that you're here on the day that this TARP announcement comes out. One wag I saw on Twitter today said, okay, so if we're making a profit on TARP, let's bring back mark-to-market accounting.
Well, for sure I want mark-to-market accounting, but that's a separate issue. You have to understand TARP as being an important phenomenon of a special time. September, October, November of 2008, when the financial markets had frozen up, when there was no trust by anybody in anybody else. And we really did need something to bring back trust in the financial markets. And TARP, you and I could talk about alternative things that the federal government could have done, but there wasn't a whole lot of time, a whole lot of leisure. In fact, the Secretary of the Treasury at the time reversed course. He sold TARP, promising one set of actions. He ended up doing a different set of actions, but we're all here alive to tell the tale, and I think that's the important outcome. And as it turns out, the taxpayer is not going to lose a lot as well. That's sort of frosting on the cake. The main thing is the financial sector didn't end up in ruins. We are here talking about the financial sector.
So was it a success then? I mean, did it need to turn a profit to be a success? As you say, it was icing on the cake. But is that something you would have ever expected?
No, quite honestly, I didn't expect it, especially after TARP money started being used for non-financial stuff, like helping with the General Motors turnaround. The important thing was getting the financial sector out of its total lockup in September, October, November of 2008, getting the financial sector functioning again. That was the important thing. No, I wouldn't have expected a profit, but gee, I'll take it.
I think this points to a really critical issue, which is it's nice that we got that money back and then some, as Larry said, but the real question is that the way you want to measure the success of this? The whole point was to turn a profit. Does that mean that they couldn't have invested in gold? I think gold has done better, probably percentage-wise.
For sure.
If that was the point, they should have been buying gold and we had made more money. I'm being facetious here. The real point is that this was to restart the economy and specifically to get banks lending again. It did save the financial system, it seemed.
But has it succeeded in doing the other?
No, it hasn't. Bank lending has been declining, and especially mortgage lending is declining. And as we know, one of the real critical drags on the economy right now is not just unemployment, which is terrible, but housing prices continue to fall. We still get really terrible numbers. Foreclosures are still very, very high. So if the point was, as they initially sold it to Congress, to get banks lending and that was going to pump fresh blood through the economy, it has not succeeded. They did get their money back, that's great, but we shouldn't change our focus in terms of how we want to measure success.
I just want to bring everyone's attention to some headlines that are crossing to the bottom of the screen now, that David Sokol is resigning. Warren Buffett announcing this. So Berkshire Hathaway, some changes occurring there. Again, Warren Buffett saying that David Sokol is resigning from the company. So we'll have some more details on that as we do get them in just a few minutes. But let's bring the discussion back if we can. Larry, what Jim is talking about here, this sort of two-pronged drags right now on the U.S. economy. The mortgage market and unemployment. I mean, I think most people have sort of given housing up for dead at this point. I mean, is there anything that can be done to bring that back? Most of the attention seems to be focused on the job market.
Well, I think that's where the attention ought to be focused, that we need to do what it takes, whether it's continued relatively easy monetary policy, some, I think, focused fiscal actions. We do have this high unemployment rate, 9%. I don't know what the Friday numbers are going to look like, but we have a problem. The economy has really not had a robust recovery from the depth. Yes, unemployment rates have come down a little bit, but we really haven't had a robust recovery. Until that happens, I don't think we're going to see a stabilizing of housing. Even after we do see a stabilizing of housing, which I hope is going to happen soon, we shouldn't go back to the ethos, the mythology of 10 years ago, where everyone starts to picture his or her house as an ATM machine, that it's an investment that can only go up. We need to have a more reasoned view. A house is primarily a place to live,
right.
And if it turns out to be an okay investment, you're ahead of the game.
Okay. And before the break, guys, we were talking about sort of the two-pronged problems in the economy, the mortgage market, as well as unemployment. And Jim, I know you wanted to make a point about the rate of housing, of home ownership here in the U.S.
Well, of course, getting back in, one of the key things that the Treasury told Congress in pushing for TARP back in 2008 was that they were going to buy assets from the banks, and then the banks were thus going to be freed from this burden, and they were going to start lending again. They then turned on a dime and decided that wasn't workable, and they were going to inject capital straight into the banks. That's how they've gotten the money back. What we haven't gotten is the increased lending from the banks, which presumably would have reflated the economy to some degree. And there's really a hard lesson in this. There's many, but one in particular, which is home ownership rates. Throughout the Clinton and then the Bush administration, they were banking that one of the great avenues to the middle class for working class families was to own your own home. Build up equity over time. That's how you're going to pay for your kids' educations. That's how you're going to pay for your retirement. This has now turned into an incredible picking of the pockets of these working class families, many of whom have lost everything. Home ownership rates rose from the low 60s up until very close to 70%, right?
That's correct.
And we thought that this was a tremendous success. We were helping all these families. Well, the rate has now slipped back down closer to 65%. We'll probably go somewhat lower. And what's critical is whether you're on the left or the right, almost all the proposals for reforming the housing finance system require higher down payments, the homebuyer paying all the fees for insuring or guaranteeing the mortgage, and tougher terms all the way around, higher FICO scores and whatnot. The point being that we're going to make it much harder for families to buy a home in the future.
Larry, is that a bad thing? I mean, you talked about some of the measures that have been attempted to boost home lending, to ease, just lending in general. But do we really want that? Would that really be a good thing?
The answer is no. Sorry, that subsidizing isn't a good thing. Making borrowing terms tougher is a good thing. We've got to keep a couple of things straight. First, we do have specific on-budget targeted programs through the Federal Housing Administration to help low, moderate income families where appropriate, sort of give them a little help to become homeowners. That's all to the good. Where I think housing policy has gone astray is broadening those subsidies so that almost anybody could get a subsidy through Fannie or Freddie or through the income tax deduction for home mortgage interest and for local property taxes. What does that do? All it does is cause people who are going to buy anyway, who are going to be homeowners anyway, to buy a bigger house, a 6th bathroom rather than 5 bathrooms, a 7th bedroom rather than 6 bedrooms, on 3/4 of an acre rather than a half. Where's the social value in that? And we end up with investing way too much of our national resources in housing and not enough in physical capital, in social capital, in infrastructure, all the things where we're running short. Well, we don't have enough because we've invested too much in housing. We have to do things differently in the future, and if it means that fewer people are buying houses, more are renting, if it means somewhat smaller houses, so be it. We'll have more resources left over to be spending on other things.
By doing that, though, don't you risk widening the gap, the sort of rich/middle class gap, by doing that? That if the only people who can afford a home are the people in a certain tax bracket?
Well, I think a much better way of addressing that is dealing with what are the things that cause low-income people to be low-income people. If it's inadequate education, let's try to figure out the ways to improve education. If it's improving retraining so that somebody can get out of a dead-end job into a better job, let's figure out ways of improving that, rather than trying to do it in a sense on the back end by subsidizing them to buy a house when, in fact, in many instances, it makes it harder for them to move from one area to another because of the high transactions cost.
Julie, I think that is a critical point. It is going to some degree to exacerbate that divide, but Larry's point, I think, is a good one, which is housing the correct tool for addressing that issue? And it might be or might not. Something else you pointed out that's terribly important, which is there's a mistaken impression out there that it was really a lot of lower income people who really were at the source of this crisis because they were the subprime borrowers. It's absolutely not true. There certainly were some, but in many instances, it was people who made very substantial incomes whose credit wasn't that great. They were, in many instances, the subprime or Alt-A borrowers. They're the ones who defaulted and went into foreclosure. So this was not a lower income phenomenon by any means. And as you said, it was people who were stepping up or who took out the second mortgages so they could take that great vacation, buy a boat to go with their house on the lake, people and that kind of thing.
Overextended themselves.
Overextended.
Absolutely.
I mean,
well-to-do people who overextended
though I was born in Brooklyn, I grew up in Southern California. I know what San Bernardino, California, the Inland Empire, looks like, and it always mystified me. How can people earning sort of middle-class incomes afford a $600,000 house in San Bernardino? I never got it.
Larry, unfortunately, we have to leave it there. Larry White of NYU Stern, Guaranteed to Fail is the book. We didn't even touch on Fannie and Freddie, but read the book. And James Sterngold, Bloomberg finance reporter. I'll be right back.